and welcome. We are live. Thank you for joining us for this live webinar with Big Al Clopine, CPA, and Joe Anderson, CFP. My name is Andy Last. I'm the media manager at Pure Financial Advisors and the producer of the Your Money, Your Wealth podcast and radio show. I will be managing any questions you have for Joe and Big Al today, so type them into the chat box as you think of them throughout the presentation, and they will get to them at the end. If you're on a desktop computer, you'll see chat on the right-hand side of your screen, and if you're watching this on your phone, it's down at the bottom. I'm going to send you a message right now so that you can see where to send those chat questions. Keep in mind, this is live. We are live, so stick with us to the very end for the best chance at getting your questions answered. There are a lot of people on the call today, and a bunch of questions are already coming in, so we're going to do our best to get to all of them. If you lose connection with us at any point, you'll see a little reconnect button at the top of your screen. Just tap on that so that you can refresh and jump right back into the presentation. Now, you may already be aware of this. Today's presentation is presented by Pure Financial Advisors, a financial planning firm headquartered here in Southern California. Pure is entrusted by our clients with over $2.5 billion in assets under management and was ranked among the top registered investment advisors in the nation in 2020 by Financial Advisor Magazine and the Financial Times. Alan Clopine, CPA, is the CEO and CFO of Pure Financial Advisors. He's provided tax planning services for individuals, corporations, and trusts for over 30 years while running multiple companies. Joe Anderson, CFP, is the president of Pure Financial Advisors. He's been helping people with their finances since the late 1990s, and he's been ranked by Forbes among the best in-state wealth advisors in California multiple years running. He was ranked number 3 out of 80 advisors on the list in Southern California. Now, please welcome your hosts for today's live YMYW webinar, Joe Anderson, CFP, and Big Al Clopine, CPA. Hello, fellas. How are you today?
Fantastic.
Joe, can I hear you?
Good.
There you are.
Yeah.
Cool. We got everybody.
Yeah, we're just kind of organizing things here. So let's see if we got, let me just go full screen. Okay, so we're perfect. We're all good. Now we're not so good. There we go, Jay. All right, we got a new guy working the cameras here today.
Well, this is live, right? And it shows already.
This is live. Okay, well, hey, welcome everyone. We really appreciate you hanging out here today. It looks like, Andy, we got a ton of people already jamming us with questions.
Yeah.
So that's what we do this. We want to make sure that we get the information out to you. A lot of different things going on right now. We are, August 26th. So we only have a few more months left of this godforsaken year of 2020. I can't tell you, I can't wait for New Year's Eve this year. So, but we have a lot of things to discuss. We got an election. So what is that potentially going to do to your overall taxes? So any questions that you have in regards to taxes, Social Security, Roth IRAs, your investments, whatever, Al and I are here to answer your questions. Andy, do we got 45 minutes or do we got a full hour today?
We've officially made it 45 minutes, but you can go for an hour because I'm sure that a lot of these people want to have their questions answered.
Well, I just want to be respectful of their time. So what we'll do is we'll wrap things up at 45 minutes. But I don't think, Big Al, you got anything going on for another 15. We'll stick around and answer any additional questions that may lead.
Yeah, love to.
Okay, cool. Anything else? Any other housekeeping items?
I think we got everything. Again, use that chat if you need to. And people are already doing that like crazy. So I think we're good to go.
Okay, very cool. So let's kind of start this bad boy and we'll get on their way. So tax law update. So basically what's new. So a whole bunch of things come out. This year especially has been unique because we've had the Secure Act that was signed just in December. And then, of course, we have the CARES Act, that relief package. And stay tuned. There's going to be a CARES Act 2.0, but I guess the House and Senate couldn't agree on what that's going to look like, and so they shelved it. There was an executive order, and now who knows, right? Now we have the election, we have the conventions, so those are more important than getting out another package. So we'll wait and see there. To introduce ourselves, I guess, my name's Joe Anderson, Certified Financial Planner. I've been doing this over 20 years. Big Al, him and I have been partners for many, many years. Yeah, we're happy to be here and happy to answer all of your questions. But why do we think that there could be some tax law changes? This is an interesting chart that just came out. So if we look back, what's this, 1913. Alan, this is when you started your CPA practice.
Oh, I almost retired in 1913, but I decided to keep on going.
The top marginal rate back then was what, 7%?
Yeah, it didn't seem 7%. So bad. Yeah, not too bad.
And then it jumps up here in 1945. The top marginal rate was 94%. And I think, Alan, a lot of people don't understand this, but it was 94% for quite a few years here.
Yeah, it was, Joe, and I think that's exactly right. People think we have high tax rates now, which I'm not saying we don't. We do, but compared to history, they're actually quite a bit lower.
And then you look at here, Reagan, it was 70%, from the late 60s all the way to in the mid 80s, like that's quite a long time. And then look at how these rates have dropped, and then they're now up to about 37%. So if you look at the history of the tax code itself, the top marginal rate was 37%. That's now 2018, 2019. We'll see what happens in the years to come. If Biden gets elected, he wants it to move back to the 39.6. If Trump stays elected, I think we'll have that 37% at least until 2026, when the Jobs Act reverts back. So interesting stuff. So it's like, well, where do we think tax rates are going to go? And then I look at this. Let me see if I remember how to do this. Is that, Andy, if I want to, how do I share a video?
How do you share a video?
I got it. You know what? I'm going to figure this thing out on my own.
Share the screen.
Right, we're going to do this.
We're going to be here all day.
Yeah, apparently.
Don't worry about it. All right. So can you guys see this on your screen here?
Yes.
So we got the U.S. debt clock, and then L, what are we at right now? This is a pretty high number here. When you look at our national debt, we're looking at about, what, 27 trillion?
Correct. That's exactly right. And look how fast it's, I mean, that's more than your gas tank, right? when you're filling up with gas.
And then here's our deficit right now of about $3 trillion. And I don't know what we're going to cut. Here's revenue over here in the green. So if we look at the green, this is kind of the income coming in. All right, well, we're green's good, but there's more red than green. So then we run these deficits. So are we going to cut Social Security? Are we going to cut Medicare? You take a look at, I don't know what's going to give. So there's ways to get out of debt. And Alan, why don't you share what we could potentially do to get out of this mess?
Well, yeah, Joe, there are a couple things. Let me find my screen here. So one, the most obvious one is raising taxes, which is why we want to have this webinar today, because that's what we think will likely happen. But also some other things that could happen is there could be printing more money, right? To, kind of get our way out of debt that way, which generally causes inflation. We could try to cut spending, but so much of what we have as far as our spending is promised benefits for Social Security and Medicare. And then you got military. You don't necessarily want to cut that. There's really, there are things that can be cut, certainly, but the big ticket items are very difficult to cut.
And you look at the interest rates right now, the 10-year Treasury, it's pretty low, right? So the cost to service the debt is not necessarily as expensive just because of interest rates are low. So who knows if they're going to increase interest rates, right? So if they increase interest rates, and then the cost of the debt service is going to go sky high. So a lot of different things that we have to take a look at. But what we want to make sure that we focus on is just saying, all right, well, here, what can we control, right? It's like there's certain things that we can control, and there's certain things that we can't control. And so we look at discipline. How disciplined are you in your overall investment strategy? The fees that you're paying in your overall investments, the risk that you're taking, and then we believe that taxes is probably the largest thing that you can control as long as you understand how the tax system works. So, Andy, you keep popping up, so you're about to tell me something.
Sorry, I was paying too much attention to the listeners' questions and not realizing that I was still on screen. Sorry about that. It's all you, Joe.
All right. Let's just interrupt anytime, no biggie. So here's kind of the agenda. I'll have Al talk about the potential income taxes changes. These are hypotheticals. This is not a political debate by any stretch. I don't care if you're on the right or the left. We're just going to give you the facts. If Biden gets elected, here's what he's thinking. So we can talk a little bit about that. CARES Act, Secure Act. I want to talk about the major things that are going on with the CARES Act and Secure Act. If you don't know, the Secure Act is almost a forgotten act that was signed in December. Then there's a tax time bomb if tax rates are going to go up, and then some tax planning tips. Andy, let's do a poll real quick with our audience before we bring Al back on. Is that how many of our audience viewers today do they feel that tax rates are going to go up, down, stay the same, do whatever? I just kind of get a gauge on what they're thinking.
All right, so I've just published that poll. You'll see it on your screen. Do you think our taxes are going to go up, go down, stay the same, or you don't know? So there's a little bit of a delay between when you hear us talk and when that poll populates. So I'm going to give it a few extra seconds here so that you can fill that in. Let us know what you think is going to happen with tax rates. I'll close this up in 5, 4, 3, 2, 1. Going to give it a couple of more seconds, and I'm going to close this poll up now. We are at 88% of people think that the tax rates are going to go up. 5% don't know.
All right, yeah. Well, I agree with the 88 and 5 because I have no idea where tax rates are going to go. But if I were to bet or if I were guessing, I think we're all in the same camp that tax rates are probably going to go up. How high, I don't know, or when, we don't know. So let's do this. Let's look at, all right, potentially next year, what income tax changes could happen if the Democrats are elected. Al, what do you think?
Well, it's right off the bat. So Joe Biden has it's not really even a tax plan. It's more concepts that he's come up with at this point, Joe, and that's what we're going to review. This is not even a formalized plan. It's certainly not anywhere near a bill or anything. Obviously, he's not president, so it couldn't be yet. But these are just some things that he's talked about. So right off the bat is ordinary income tax changes. What he's essentially talking about, Joe, is to increase that highest marginal rate from 37% to 39.6, which is what it was previously. And I think we got it on the next slide. If you go forward, we can show you what the current rates are. They start at 12%, 10%, 12%, 22, 24. I'm on the top line, all the way to 37%. These are graduated rates, and I need to make sure everyone follows and understands this. If for some reason, let's say you're married and your taxable income is $100,000, you are in what's called the 22% bracket, which starts at about $80,000. But you don't get taxed on 22% for the whole 100,000. The first roughly $20,000 is taxed at 10%. The next $60,000 roughly is taxed at 12%. Right, and then the next, 20,000 or so is taxed at 22%. So that's how this works. So when we're looking at the highest rate of 37%, that's what we have right now. And then we can also take a look at 2026. Let me get myself out of the way so you can see this. So in 2026, we revert back to the old rates, and they're similar in the 10% rate, but the 12% becomes 15, 22 becomes 25, 24 to 28. And so on. The highest rate's 39.6. Now, under Biden's proposed rate, and again, these are more concepts. It's not a bill or just more of a discussion at this point. Everything would stay the same except that highest bracket of 39.6. All right, next slide. Okay, good. All right, another concept that is being thrown around is increasing capital gains tax. Now, this won't affect most of us, but what he's suggesting is that there is no special capital gain rate when you get to income of over $1 million. So it just becomes the ordinary income tax rate, which is pretty different than what it is right now. The highest capital gains rate, so this is when you sell real estate, a stock, bond, portfolio, a business, and you've held it for at least a year, you get a 20%. The worst case is a 20% tax. There's actually a 0% range, 15% range, and a 20% range. Then there's the net income investment tax, which kicks in at 200,000 of income, single, 250,000 married, where you have to pay an extra 3.8% amount. So with Biden's proposal discussion is once you reach $1 million, that 20% capital gains rate is just taxed at ordinary income, which would be 39.6. So let's call it 40%. So the tax rate actually would double federal. Of course, we're talking federal only, not state. So that's one thing to be aware of. Another thing is no step up in basis. And this one's a little bit controversial. Right now, when someone passes away, their heirs get their assets at a stepped up basis, which simply means, let's say your parents bought their home for $50,000 and they pass away and now it's worth $600,000, to give you an example. When you inherit that property, it's as if you bought it for $600,000. That's what's called step up in basis. So when you sell it at $600,000, let's say you sell it immediately, there is no gain because you got that step up in basis. Now, under his proposal, that would go away. So the person that inherited the property, not only would have to pay the tax, but they'd have to pay the tax on death, on the passing of your parents. Joe, this one to me is very unlikely to go through because I don't think people really fully understand what this means. This would affect mom and pop and everybody else. This isn't just the 1%ers on this one. This is virtually everybody. Yeah,
without question. It's been floating around for years, though, that they would get rid of the no step up in tax bases. I think a few years ago, Al, they were thinking, all right, well, we'll step up anything around $400,000, and anything over $400,000 would not receive a step up. So let's say if someone that's in the 10 or 12% tax bracket inherits some wealth from their parents, grandparents, or Uncle Jimmy, right, they're not going to get affected. But what they're trying to, I guess, alleviate is that the big Rockefeller families continue to pass wealth through generation to generation to generation. So we'll see. They throw all sorts of different things, and I think right now with Biden's plan, that $400,000 figure is kind of a key figure because that's where the increase in ordinary income rates. He's like, I don't want to raise anything for people making under $400,000, but if you're making more than $400,000, we'll probably see these increasing capital gain rates. No step up in basis. Let me quickly go here, and then with Social Security too. So people making over $400,000, they want to add additional payroll tax to those individuals.
Yeah, that's kind of an interesting one, Joe, because right now the first $137,000 of what you make, you have Social Security taxes withheld from your pay. Your employer matches that up. And then over that, there is no more Social Security. But what Biden is suggesting is keeping the 137, and then the Social Security stops. But then again, at 400,000, it starts up again. So some people have called that kind of like a donut hole in terms of where you have a certain range where it's not taxed, and then it becomes taxable again. Again, what he's trying to get at is trying to tax the 1%ers a lot more.
Yeah, and then when it comes to corporate rates, right? It's still relatively low on his plan. So I guess all in all, that's not necessarily a bad or good thing.
Yeah, so they were at 35% for large companies, 34% for smaller companies. During President Trump, they brought it down to 21%. Biden is suggesting taking it up to 28%. And when we're talking about corporate income tax rates, we're talking about only C corporations. Not S corporations, not partnerships, not LLCs, just C corporations.
Yeah, because those LLCs, S corps, those are flow throughs. So those just go to the individual owners, 1040. All right. So let me talk real quickly on the CARES Act, and then we'll break for a second here and then answer some questions. I'm sure that we got a ton. Right through the CARE Act, they came up with the CRDs, or the coronavirus-related distributions. For those of you that are not familiar with the CRD, it's the availability for us to grab money out of our retirement accounts up to $100,000. If you qualify for the CRD, and basically like the private letter rulings is like almost everyone qualifies. But here's what it states, is that if you've been diagnosed with COVID, a spouse, a significant other, right? If you had any adverse job change, let's say if you were furloughed, laid off, reduced hours, maybe you had to take care of a child, a grandchild, or something like that, where you had to stay at home. So any type of like financial hardship, anything at all, you qualify for the CRD. Well, what is it? It's the availability to grab money from the retirement account and avoid any type of penalty. So if you're under 59 and a half, you can pull $100,000 out of the account. And they won't withhold any type of taxes, and they waive that 10% penalty. And it gives that individual the option to either to pay it back over a 3-year time period. So, hey, I need the $100,000 today just to cover some bills. I got laid off. I got reduced hours, whatever it is. Let me take the $100,000 out, spend it, use it on living expenses, and then it gives me the opportunity or the availability to pay that back over a 3-year time period. So it's like a loan that you can take interest-free from yourself and pay it back. Or like the 60-day rollover rule. It's a 3-year rollover rule. So it's for people that need the cash flow, it's a huge deal. For other people that don't necessarily need the cash out of your retirement account, it still might be a good option for you to take it anyway. Because if you think tax rates are going to go up, everything that is sitting in a retirement account is going to be taxed at ordinary income rates. So the CRD, you can pull money from a retirement account up to $100,000, but then spread that tax liability over 3 years if you don't want to put it back into a retirement account. So you pull out $100,000, then you pay then $33,000 roughly, and some change shows up on your tax return this year, 33 and a third next year, 33 and a third the following year. So you can take a big chunk out of a retirement account and spread that tax over a 3-year time period. Another thing that we're seeing people do is they're pulling $100,000 out of, let's say, their 401k plan, and they're moving it into their IRA because they want more control over the dollars, lower fees, better investments, whatever. It just might give you more control. Some people were calling it like a 403B rescue, some stupid name, I forget what it is. But for those teachers out there that have some like high-priced annuity plans for their retirement accounts, this could be a good option to get it out of that plan without any taxes, fees, and penalties, and move it into maybe a lower cost option that gives you a little bit more control. So that's a CRD, coronavirus-related distribution.
Hey, Joe, one more thing is there's no 10% penalty. So you can do this at any age. So you can avoid that penalty. And then, as you said, you pay the tax slowly. You pay 1/3 each year for the next 3 years, but you can elect to pay all the tax this year if you think you're going to be in a much lower bracket.
Right, yeah. So let's say if you got laid off and you have no income this year, you might want to pay the tax this year. And it's up to $100,000. So you can take as much up to that limit, and it's $100,000 per couple, or it's basically $100,000 per person. All right, so elimination of RMDs. So 2020, there is no required minimum distribution. So what is an RMD? And once you reach age 70 and a half, now 72, we're required to take a percentage of the overall retirement account out as income. The reason the RMD exists is that because you never pay tax on those dollars, you got a tax deduction going in, it grows tax deferred, but when you pull the dollars out, then that's when you're taxed at ordinary income rates. So because of the pandemic and the high volatility of the overall market, they're like, you know what, if you don't necessarily need the income, you don't have to take it, and they're trying to help you avoid taxes. What we believe is that if you have a required distribution this year and didn't take it, you still probably want to take the RMD, just because we're in all-time low tax rates just about. I mean, if you look at the chart, I mean, we haven't seen tax rates this low in many, many, many years. And I don't know if they'll ever go this low ever again. So to get money out of a retirement account at these tax rates, I think is a huge deal for all of us. So if I were 72 and needed to take an RMD, I would still probably take the RMD, pay the tax. But with this year, what you could do is you could take that RMD and actually convert it into a Roth IRA, pay the tax on it, get it into a Roth IRA, have it grow 100% tax-free, and just know that there is no required distributions in a Roth, so then that can compound tax-free for you. Real quick on the Secure Act is that this is the biggest one. When we're talking about retirement accounts, they eliminated the stretch IRA. And the stretch IRA basically is this, is once a non-spouse beneficiary inherits a retirement account, before they could spread the tax out over their life expectancy. So let's say if a 20-year-old inherited mom and dad's retirement account, right? Well, their life expectancy might be another 65 years, right? So they would have to take 1/65th out of the overall account. So a very small component of it. So all of that could continue to grow tax deferred. It was a huge tax benefit. It was awesome. But then we could see the writing on the wall a few years ago when the Supreme Court stepped in on one case and said, you know what, an inherited IRA does not have the same protections as a normal IRA or 401k in regards to lawsuits and bankruptcies. So we're like, okay, they're claiming these are not retirement assets. The retiree is passed. And if you inherit a retirement account, they're not looking at as a retirement asset. So we're like, well, it's just about a matter of time until they get rid of the stretch IRA, which they did. So you cannot stretch the tax liability out over the non-spouse beneficiary's life expectancy. It needs to get forced out of the overall account, depending on how that beneficiary form is filled out, within 5 or 10 years. Okay, it's forced out, so that's potentially going to be a fairly large tax burden to that beneficiary. So just understand, for those of you that have large balances in 401ks, IRAs, 403bs, TSPs, whatever, these retirement accounts, defined benefit accounts, right? There needs to be some sort of organized strategy or plan. Just because they eliminated the stretch IRA, you're going to lose potentially a lot of money to unnecessary taxes at your passing. If you don't maybe take a look at what is the best option for you. 2 other quick ancillary things: that they got rid of the age limit for IRAs. Before you were cut off, you couldn't put money into an IRA at 70 and a half. Now there is no age limit. So if you're still working, if you have earned income, you can still put money into a retirement account. IRA or Roth IRA, doesn't necessarily matter. Andy, let's stop there real quick and see if we have any questions in the group.
First of all, I will say that I've never seen this many people in a room in one of our webinars. So thank you all so much for joining us. And thank you for this incredible number of questions we've got. So I'm going to start with the CRD questions because a couple of them are rapid fire. Ilona, one of our listeners from the podcast, asks, does the CRD withdrawal count for the pre-tax IRA?
Al, you weren't listening, were you?
No. Neither were you.
I know.
Does the coronavirus-related distribution withdrawal count for a pre-tax IRA?
Yeah, so let's say if I have a retirement account, a pre-tax IRA or 401k, and if I want to take money out of that overall account, right, so it's pre-tax, you pull it out of the account, you can pay it back over 3 years, or you pay the tax over 3 years. So the benefit of taking a coronavirus-related distribution, let's say if you didn't need the capital or the cash, right, you would want to pay the tax over 3 years and put it into a brokerage account that's going to be set up at a capital gains rate versus ordinary income. So yes, those pre-tax IRAs, that's where you would want to use the CRD or the coronavirus-related distribution.
Yeah, because
Greg,
the extent of the pre-tax portion, that portion is non-taxable, so you get some benefit that way.
Okay, next question is from Greg. Can you take advantage of the CRD if you're over 60 years of age?
Yes, any age, as long as you qualify for a CRD. So what does that mean? Is that you had any type of adverse financial situation. So furloughed, laid off, if you've been diagnosed with COVID, your spouse, significant other, child. So basically it's a broad brush of what the qualification is for a CRD.
Mark would like to know, if I took $100,000 out of my IRA under the CRD, is there any way to put this money back into a Roth IRA without it counting as a conversion and bypass the taxes on this $100K?
You want to go to jail?
The answer is no.
So here's, we get this question with the coronavirus related distribution is that, all right, let me take the money out of my retirement account, which is fine if you qualify, right? And then what the law states is that you, as long as it goes back into any qualified retirement account, I take it out of 401k, I put it into an IRA, you're fine. I take it out of a 403b, I put it into an IRA, you're fine. And I pay the tax over 3 years. So I got 100,000, I pay it back. All right, do I pay the tax over 3 years, or do I pay the account back over 3 years? The question you're asking me is this, is that can I take it out of the 401k plan or IRA, let me put it back into a qualified retirement account, a Roth IRA, right? And pay it back pay the Roth back over 3 years and avoid the tax. Well, no, it went from pre-tax to after-tax, and it will forever grow tax-free. So you absolutely need to pay the tax on that. The second, I guess, question is that you could be asking me is that Can I do that? Can I take a coronavirus-related distribution, put it into a Roth IRA, and then pay the tax over 3 years? There's no way to avoid the tax, so forget about that. But can you now put $100,000 into a Roth and maybe pay the tax over a 3 year? The law does not say that you cannot do that. Our opinion is that's not the spirit of the law.
Yeah, I agree with that, and I think there's a danger that if you do that, it'll come back and bite you later when they look at this more closely.
Devi would like to know, can we convert RMD into a Roth IRA if we are over 70 and a half?
This year only, because there is no required minimum distribution. So let's say in the past you had a required distribution of $10,000. You could not then convert an RMD. A required distribution is just that. You have to take the money out, pay the tax, either spend it or save it. But this year, they eliminated the required distribution. So what Al and I are suggesting is that if you still have that $10,000 that you're used to paying tax on, might as well still take the $10,000 out and then put that into a Roth. You can do that for 2020 only because they eliminated the required distribution.
Okay. Let's see. Priya, can I convert my Solo Roth 401k to Roth IRA, an employer portion of Solo 401k to Roth IRA, paying taxes next year after contribution year?
Priya, didn't you just ask us this? Didn't I just answer this question on the podcast?
I think we did last week.
Might not have gotten the answer yet. It might have aired on radio, but not on podcast yet.
I think she's probably the same one.
Yeah.
Los Angeles, maybe? I don't know. Small business owner? Yes, I guess what she wants to do. What does she want to do again?
She wants to convert her Solo Roth 401k to Roth IRA and the employer portion of the Solo 401k to Roth IRA, paying taxes next year after contribution year.
Yeah. Here's what you do, though, right? You can just convert. You got a 401k plan, and then you have pre-tax, and then you have Roth. So you just take the pre-tax component of the 401k plan and say, I want to convert this into the Roth IRA. You don't have to necessarily, because then you're going to have to set up another solo 401k and do the same thing. I mean, or you refund the old 401k. I don't know. I mean, it sounds to me that she's taking another step that's unnecessary, Al, but either way, it works. You just know that you pay the tax on whatever that you convert that is pre-tax.
Okay. William says, does the state of California tax retirement income, IRA, differently than W-2 or 1099 income?
No, it's exactly the same. It's ordinary income. California has a graduated schedule that starts at 2%. It goes as high as 13.3% if you're over $1 million of income. So it's considered ordinary income, just like a salary. So it's taxed the same way.
Okay. Aaron has two questions. Should I roll over my pension/annuity amount to a rollover IRA? Annuity returns are minimal compared to equities. Second question, confused on how much I can convert to a Roth IRA from 401k plan on a yearly basis tax efficiently. My gross income is $90,000.
Okay. I'll take that one out. So if you got a pension that you want to roll into an IRA, absolutely you can roll that into an IRA, no big deal. You just have to fill out the appropriate paperwork, then that money goes into the IRA, then you can invest in equities or whatever that you want. If it's in an annuity, just be careful with surrender charges. Depends on when you purchase the annuity. So if there's back-end surrender charges, just understand that. But in most cases, if it's a variable annuity, the internal fees alone is probably going to make it worthwhile to get out of it, because what we see is anywhere from 3 or 4% internally. And you might have a back-end charge of, let's say, 6%, but do you want to pay 6% once or 3 or 4% every year? And you know what I mean? So you just want to look at that. What is going to be the most effective way to convert? Now that's where it gets a little bit more challenging, because, hey, I don't know how much money that you have in a retirement account. I don't know so you got $90,000 of income, but is that, I don't know how old you are. I don't know when you're going to retire. I don't know what your fixed income sources are. So I guess some things for all of you to consider in regards to a conversion strategy. There's one thing that you can do. You can just max out your current bracket, right? That's an easy way to look at it. $90,000 of gross. Did she say she's single or married?
Aaron did not say.
Okay, let's say you're married. At $90,000 of income, take the standard deduction. What is she in the 12% tax bracket?
Right.
And then so you look at the top of the 12% tax bracket is roughly $80,000. So you look at your taxable income, which this year now is line, 11B, something stupid like that?
Yeah, it keeps changing. I don't know.
Look at taxable income. I think it was line 10. It was line 43 for years. I think this year they changed it again. So look at your taxable income. That's the most important line on your return. Look at your taxable income, and then look at the tax chart to see, okay, how much room do I have in my current tax bracket? That's basically a real easy way to, at least get you started. There's a lot more complex ways to really maximize how much money that you have in a Roth. But if you're thinking, hey, that's a good stepping stone, because, hey, you're not going to pop yourself up into a higher tax bracket that you're already in. So hopefully that helps.
Yeah, let me just kind of put some numbers to this. So at $90,000 of income, if you're married and $25,000 standard deduction, so your taxable income is $65,000. That's your starting point. And to get to the top of the 12 is $80,000. So you would convert $15,000. Whether that's the right number or not for you, we have no idea. We need to know a lot more about you before we can say that. But that's the concept.
All right. And Aaron and anybody else, if you want to dive a little bit deeper into all of this, you can email info@purefinancial.com with more details, and Joe and Big Al will be able to answer those privately. So shall we move on to the next question? Do you want to go on with more presentation, Joe?
Give me some more.
All right, you got it. George would like to know, could I take a CRD from the Roth portion of my 401k and put it into my self-directed Roth IRA?
Sure. As long as you qualify for a CRD. All right, so George, is that his name?
Yes.
All right, so George probably wants to buy real estate, I'm guessing. I don't know George. But George has a self-directed IRA, and George, let me know if I'm right or wrong here. But he wants to take it out of 401k, move it into the self-directed, or maybe he wants to buy Bitcoin, gold, I don't know. But yes, you can do that as long as you qualify for the CRD. Again, if you were diagnosed, your spouse was diagnosed, you were furloughed, laid off, you got to take care of some kids, whatever. Just make sure that you understand the rules to take the CRD. But yeah, you can take it from a 401k, move it into a self-directed IRA. Sure.
All right. Steve would like to know, when would Biden's higher tax rates take effect?
That's a great question. So if he becomes president, so he wouldn't even be sworn in until January 21st, I believe. So then he would have to come up with a tax bill, which then would have to go through the House and the Senate and for him to sign it. Now, could that happen next year? Yeah, it could. It's possible. Probably later in the year. Typically what's happened in the past, and the past is no guarantee of the future, but if you go by past changes in tax, anytime there's been a tax rate change of ordinary income tax, it gets pushed to the following year, which would be 2022. As far as capital gains, we've seen capital gain changes before mid-year, and what's happened in that case is on the date of the enactment. Before that, it's at one rate, and after that, it's another rate. So if you sold your company or real estate or stock before that date, you got the old rate. If it's after that date, it could be the new rate. And that's based, since when you sell a capital asset, they can do it that way mid-year.
Following on from that is a question from Ricky. He's a regular listener to the podcast. He says, when do Trump's tax cuts expire?
2025 is when they expire. So 2026, expect to have the old rates back. And we can go through those in a second. So 2025 is where they're scheduled today to revert back. Andy, Darlene made a comment here saying pulling money out of a retirement account has stipulations on when you pull it out. Is that a comment?
That's a good question. Is that one way down on the list? Because I've apparently missed it.
I like how sometimes people will put these comments in there like, hey, you don't know what the hell you're talking about. Yes, I get that there's stipulations on when you pull it out. If there's no stipulations on when, I mean, if you're doing a CRD, right, you can pull it out whenever. It has to be done this year. Maybe that's the question. So if you want to do a coronavirus-related distribution, you have until 12/31 to do it. If you took money out in January 1st, let's say you get diagnosed with COVID, you could still qualify for the coronavirus-related distribution.
Yeah, it could be, Joe, because typically when you're in a retirement plan, unless you're 59 and a half, you do not have access to those funds until you either are terminated or leave or separate from service or become 59 and a half. But with the coronavirus distribution, you can do that at any age. So maybe that's what she's talking about.
Yeah, but it's still up to plan document. So if your employer is like, no, we're not going to update the plan because of the coronavirus related distribution, that might have something to do with it too. So, all right, sorry, Andy.
Kathy would like to know, I heard that from your podcast, someone could use the strategy to harvest capital gain when income is lower. Does this apply to any amount of capital gain? For example, an individual taxpayer has 30K of income this year. If that person harvests 10K of capital gains, then pay 0% for the capital gain. What if they harvest 100K capital gain? Then that brings the total income to 130K. Would it still be paying 0% capital gain?
No, we get that question a lot. So to the extent the zero capital gain rate is currently to the top of the 12% ordinary income tax bracket. For a single taxpayer, that's about $40,000 taxable income. For married, it's about $80,000. So in your example, it's only the first $10,000 that's tax-free at zero. Anything above that will be taxed at 15%. And realize that depends upon your state. Like we're in California. California doesn't recognize that 0% capital gains rate, so you will pay capital gains in California.
All right. Brian says, I'm retired. For my income from investments, do I need to keep them below the total of $240,000? This would be the total of my sales, capital gains, interest, short-term, Roth conversion, question mark.
To keep it below the 240,000?
Yeah,
I assume that's income level?
I'm not sure what that's referring to.
Okay. Brian, give us more information if you can, and we'll see if we can answer that for you.
So let me go here real quick because this always kind of sparks some questions as well. And if you've never seen this before, this is probably the first time you've ever listened to our show. You're good. Okay. I don't think you have to turn it. Maybe Andy will put it full screen for me. But if we go here, right? Let me go this. She's reading questions. Andy, give me full screen. There we go. All right, cool. All right. So when we look at kind of investing, you got tax-free dollars, you've got taxable dollars, and you got tax-deferred dollars. So with each of these different pools of money, there's different tax strategies of what you want to take a look at. Okay, so we had questions in regards to tax loss harvesting or tax gain harvesting. Those would be assets that are sitting in this account. So that could be a brokerage account. So this could be mutual funds or stocks or bonds, real estate even. Anything that is held outside of a retirement account. When you pull dollars out of these accounts, they're taxed at 15% for most of us, right? The highest rate today is 20% on the capital gain. The lowest is 0. Then you have the net investment income tax. That is, I'm losing this. Got it. So when we're looking at cap gains rates, this is what Brian wants to do is use this 20% for the highest taxpayer. I'm guessing that he said $1 million. It could go down if you have $400,000 or more of income. This would then turn into ordinary income. The highest rate would be 39.6 here. So when you're looking at, all right, if I believe that tax rates are going to go up, no matter where your account is held, it might make sense to tax loss harvest or tax gain harvest. Tax gain harvest is using the 0% rate. So if you have a tax bracket that is in the 10 or 12% tax bracket, you can sell an asset up to that level and not pay a dime in capital gains rates. You could buy the same asset back. You have Apple stock that it took as a good run. You could sell it at that level, pay 0 tax, and then buy it back at a higher basis. It's called tax gain harvesting. Those are assets that are sitting in this account. And if you have a lot of income, you might want to look at some tax strategies in case Biden gets elected. You know, we're seeing these rates double, right? You're going to be losing half of, let's say, if you sell a business, you have a real estate transaction, or you have something like that. These assets here could get in trouble depending on how much income that you have. If you sell a business, your income in most cases for that year will be higher than, most, right? Most people. Your tax deferred assets is where most of you hold your assets, right? These are the IRAs and the 401ks and the 403bs and everything else. So when you pull dollars out of here, it's going to be taxed at ordinary income. 90% of us believe that tax rates are going to go up. So it might make sense to start taking dollars from this account at a lower tax rate. So there's two ways to do that. We talked about a CRD. Take money out of this account, you can move it over here. Spread that tax liability over 3 years. Or you can take dollars from these tax deferred accounts and move them up into this tax-free account, right? So that would be the Roth. Every dollar that comes out of here, you're never paying tax ever again. It's 0%. So here you got ordinary income. Does it make sense to do the conversion? I think it does. You're going to have to pay the tax today on the conversion, but you're buying that tax at an all-time low rate. Now your money's sitting up here, and these dollars will forever grow tax-free. You'll never pay tax on those dollars again. Another issue to consider is that if you have a lot of money sitting in here, and you want to give it to the next generation, kids, grandkids, nephews, nieces, the stretch IRA is no longer, right? So these dollars are going to be taxed potentially at a lot higher rate. It's going to be accelerated out of these plans quicker than they ever have, right? So what does that mean? More dollars that come out of this account means more taxes, okay? And if all of your money is sitting in this account, as you create retirement income, as inflation goes up, tax rates are going to go up, and all of my money is trapped in this account, you're going to get hammered with tax. Now is the time to control this thing, right? To get a handle on it. Because if everything is here, we already know, I mean, we don't know, but I think we all agree that tax rates can go one way. I don't think they're going to go down, okay? But if they go up, just know the toll to get your money out of here is going to increase. So does it make sense to buy the tax cheap and then have your dollars forever grow tax-free? I think we all know the answer to that because there is no RMD here. If it goes to the kids, 0% tax, okay? So a couple ways to get money here. You could do a contribution of $7,000 if you have earned income and if you're over 50, or $26,000 into that 401k plan, right? If you're over 50 and if you have a Roth component. So stop ignoring this account and hopefully start utilizing it, because then it takes the uncertainty of taxes right off the table, So things to consider this year: RMDs are waived. Still take it, but move it up here. Coronavirus related distribution, take it, move it over here. Get subject to capital gains rates. Right? If you have a transaction that you're holding off on, you got a piece of property that you've just been like, you know what, I want to keep selling this, but I don't want to pay the tax. This year might be the year that you probably want to sell it, because I don't know who's going to get elected. It's usually a crapshoot. If I'm betting, I would much rather pay these rates than, even though if it's a hypothetical that I could pay a lot higher. I don't know. Maybe you want to make that transaction now. I'm not making any predictions, but I'm just saying. All right, Andy, more questions before we kind of continue on with some of these?
Sure, absolutely. Let's.
Before we do that, I can't believe we've already gone 48 minutes.
Yeah, exactly.
So a few things here. What we want to offer you guys is the opportunity really to kind of button this stuff up. I know a lot of you have come through our doors. We all miss you. We wish, we're with this whole COVID thing is remote. I mean, I'm in this classroom all by myself. Al, I don't know where the hell he's at. He likes to wear those headphones. If you ever see him in this grocery market, he's got a mask and those headphones on.
Absolutely. I love that look, Joe. I wear a blazer with shorts.
Then you get the question. They're like, oh, are you on the radio? And you're like, how do you know? Because you got stupid headphones on.
Well, plus I wear a T-shirt that says Big Al, radio star.
So if you guys want to get a second opinion, or maybe get a tax strategy in place, this is by far our busiest time. We wanted to put this webinar out to kind of give you some more ideas, to get you motivated. Hey, things could be changing. Things will change at some point. Things will be a volatile ride from now until the end of the year. get things buttoned up. If you want to take advantage of a free, tax reduction analysis, we can look at your return, look at what you got going on, and give you some ideas. Right, it's pretty high level, but we can map some stuff out for you. Please take advantage of that. That's our gift to you, Andy. If you want to just throw up that special offer, pop it in there and do it. Take advantage of it. I think in most cases, Big Al might be able to find you a couple of bucks. If I look at it, you're SOL, right? So hopefully, if you do it right now, you'll get Big Al. If you wait 5 minutes, you'll get me.
Do you want to do some more questions?
Sure, why not?
David would like to know, does Pure use sophisticated SW tools to enter all of the specifics to optimize tax consequences and Roth conversion strategies based on multiple scenarios and assumptions?
Absolutely not. We'd make it up. Yes, we use a tax software, of course. We'll plug in the numbers and we kind of take a look. We want to map it out because you don't want to mess around with taxes, right? Because you don't want to pay more than your fair share. We want to reduce that dollars as much as you can. We have CPAs on staff. Of course, Big Al's a CPA, but we got planners that really take a deep dive to look at all instances, right? Because if your income goes up, then potentially your Medicare premium goes up, right? Does that phase out of certain type of credits? There's all different things that you want to look in regards to this stuff. Al, do you got any other comments on that?
Yeah, no, same. We use BNA software with tax projection software, which is the best in the industry, and we can run unlimited scenarios, and we do sometimes because a lot of times there's multiple choices, and you don't really know what's going to be the best till you kind of look at it in black and white.
All right, Kathy, this is a different Kathy. We've got a couple of Kathys on the call. Says, if my married tax rate is 32% and I'm at the top of my tax bracket, then it looks like converting money out of an IRA into a Roth IRA does not make sense?
It depends on how much money you have in the retirement account, to be honest with you. I know it's kind of vague, because if you're going to have to look at a couple of things. What's your tax bracket now, and what do you believe your tax bracket's going to be? Just super high level, easy type. Well, if I'm in the 32 now and I'm going to be in the 12% in the future, well then yeah, you don't want to pay 32 if you think you're going to be in the 12. But I believe the 12% is going away. It'll be the 15. The 32 is probably going to 35, right? And then you have to take a look. And then what they did is they broadened those thresholds too, Al, of the 10 and 12%, 22% tax brackets were roughly the same, and then they just opened up the 24% bracket to a huge dollar figure. They're going to shrink those things down, so it would take a little bit more analysis, I guess. But if you're in the 32, and if you've got millions in a retirement account, I would convert all day long. But if you got a couple $100,000, you're not going to run into problems because your RMDs aren't going to be that big. Maybe you have a pension, Social Security, and so it really depends.
All right. Andrew says, can you tax loss harvest for your stocks and apply against gains on converting an IRA to a Roth?
The answer is no. That would be a capital loss, and so you can use that against any other capital gains, stock sale gains, real estate gains, but you can't use it against ordinary income, which a Roth conversion is ordinary income. So no, unfortunately, you can't.
All right. Sally says, I am 70 and a half now. Should I take my RMD TSP now and put it in Roth TSP, or should I wait until 72?
I would do it now just on the surface, but it depends. Might as well. I mean, if you believe tax rates are going to go up, buy the tax, get into the Roth, have it grow tax-free, and never worry about it. That's a blanket statement. That's not advice. That's just a couple of kids just having a conversation about Roth IRAs.
Yeah, and let me add my own blanket statement, which is I think virtually every single person in the country should be considering Roth conversions that have an IRA or a 401k. Not everyone should make them. It depends upon your circumstances, but a lot more of you should make them than you would think would be the case.
Ricky would like to know, what is the RMD requirement for a beneficiary Roth IRA?
Ricky, I guess this is kind of a weird. Are you already the beneficiary, or are you banking on being the beneficiary? So it depends on your age. If you haven't inherited the funds yet, you're going to have to take the dollars out between 5 or 10 years. It depends on if it's a designated beneficiary or a non-designated beneficiary. That's kind of getting in the weeds here, but it depends. But let's just say it's a designated beneficiary and you are named that designated beneficiary of a retirement account and you inherit that money this year, you will have to take the money out within a 10-year time frame. It's not 1/10. You can take it out all in 1 year, not take anything out till the 10th year and pull everything out. But if you are already receiving, or if you already inherited the money, it depends on your age. And if you haven't been taking a required distribution as a beneficiary of an IRA, you owe a 50% tax penalty each year that you didn't take the RMD.
I think
so,
one
sorry,
thing,
someone died, and then now you got a bunch of penalties.
Yeah, I think one thing that's important to kind of reiterate is that if you got the beneficiary IRA before this year, 2019 or before, all the old rules stay in place. They don't change. So let's say you've been taking your RMD for the last 5 years, beneficiary RMD, it still continues as a stretch IRA for the rest of your life. It doesn't change. The old beneficiary IRAs get grandfathered in.
Right, and then I guess with the CARES Act, you would not have a required minimum distribution on a beneficiary IRA in 2020.
We have a bunch more questions. Do you want to keep going?
Yeah, I'm fine. I want to hang on as long as we can. It looks like we got everyone. I think we got 4 people that dropped off, and it was probably George because he got upset because I said you're going to buy Bitcoin with your self-directed IRA. Hey, let's do this too. We have this podcast survey. Andy, you want to throw that up for because we still have a couple hundred people on this call.
Yeah.
Throw that out there. We got a survey that we want you to fill out. We threw a bone. What we're going to give them something.
We're going to give them a $100 Amazon e-gift card. It's actually if they fill out the podcast survey, they will be in the running for the e-gift card. It's $100 at Amazon, and that will be the winner will be announced in the podcast on September 22nd. So you still have about a month to fill out that podcast survey. Let us know what you think so that we can actually try to make the podcast better for you.
Or these webinars better. All sorts of stuff. So if you guys are fans of the TV show, the podcast, our radio show, whatever, we try to give good content, good information out timely. So we lost another one. Maybe that was George.
All right. Rodney would like to know, with estate tax changes potentially coming, certainly a cut in the exemption, but maybe even more punishing measures such as eliminating stepped-up basis, are there strategies such as ILIT or other to protect Uncle Sam from smacking down our beneficiaries?
Well, and ILIT is an irrevocable life insurance trust, and those are set up so that you have a life insurance that is not part of your estate. You pass away, and the proceeds go to the insurance trust, which doesn't get included in the estate taxes. That's been a good strategy. It will continue to be a good strategy, regardless of what happens. Even if we lose the step up, and the estates have to pay the step up, the appreciation, the tax on the appreciation right away. They're going to need some money to do that. So that is a way to go. I think something that people should be looking at right now is currently we have about $11.5 million exemption per person. So now is a really good time if you've got a lot of assets to start transferring to trusts that you're not trustee, that you don't control anymore, or kids or grandkids, whatever. Get those out of your estate, because if we go back to $3.5 million or $5 million exemption, the IRS has already said that they're not going to claw back that excess that you took out. So now is actually a really good opportunity.
All right, Greg, I think we're going to need more information from you. Greg asks, I'm 60 and married. How much can I contribute and or move to a Roth? I did have earned income earlier this year before retiring in July.
So he's married. You can make a contribution of $7,000 for you and your wife as a contribution to a Roth IRA, as long as your income was under $200,000 for this year, which if you stopped in July, I would imagine you were probably under that threshold. Conversions, you can take money from this account or your Roth account or your IRA account and move it into your Roth account. This is unlimited. You can do as much as you want here. But it's going to be subject to income tax. So you just want to make sure that you understand what tax bracket that you're in. So if you retired in July, and let's say you make $100,000 annually, well, if I retired in July, I can assume that maybe my income was $50,000 for the year as income. Then I take $25,000 out for my standard deduction. And so my taxable income in that example would be $25,000. right? So I have room up to around $85,000 to stay in that 12% tax bracket. So those are the math, those are the things that you want to look in, right? What's your income? What's your taxable income? And what tax bracket are you in? And how much room that you have is going to determine your first step of a conversion strategy. But just know that you pay the tax when you convert. So you just want to make sure you understand what bracket that you're in so you don't get surprised when Uncle Sam sends you the bill.
All right, I've got a bit of a long question. This one's from Richard. In 2002, I put $2,000 in a small cap mutual fund. And in 2002, the brokerage company didn't use to calculate the basis and list it on your statement. By 2007, it had grown to $11,000. Then Wells Fargo bought the company, changed the name of the fund to the Wells Fargo Small Cap Fund, and the basis started to be listed on your statement every month. On my statement, I noticed it indicated the basis was $11,000. The company then got absorbed by another Wells Fargo fund and was now called something else. The basis was now listed every month on my statement as $13,000. The fund subsequently has fallen to $9,000. The fund basis is still listed around $13,000, give or take, as I think they average on cap gain and dividend repurchases. When I sell the fund, do I have to use $2,000 as basis, or do I use $13,000 as basis, since this is what I believe the company reports to the IRS that the basis is?
So
did you get all that?
Yeah,
I did. I'll answer that two ways. So
first of all, you bought a really bad fund. Was that Strong? Is that what he said? Yeah,
yes.
I remember they were out of Milwaukee, Wisconsin, I believe, or somewhere out of Wisconsin. Strong. I met that guy. It was the Strong family, and I think they ended up not doing very well. Anyway, sorry.
No, so from a matching standpoint, you sell it for $9. Your basis is $13 on the statement. No one's ever going to question it. Is that a good way to go? Well, it's a way to go. It's not.
Will you be able to sleep at night? Is that
right.
Is it morally ethical?
Yeah, you may not be able to, right? So what you're supposed to do, though, is you put the $9,000 as your sales proceeds, you put the $13,000 as the basis, and then you have an $11,000 negative adjustment to basis that makes it into a gain instead of a loss, and that all gets done on Schedule D. That's what you're supposed to do. What you decide to do is up to you, but I can tell you what the IRS is expecting: $9,000 and $13,000. That's what they're expecting because that's what they have.
What would you do, Al?
I would do it right. I got to sleep at night.
Oh.
Plus I'm a
I'll tell you what I would do.
I know what you would do. But I'm also a CPA, so they don't look at things like on CPAs very kindly, but we don't do them right.
All right, I'm just looking through. We have a few more questions here. Some from
one more, then we'll wrap it up.
Okay, let's see. Let me pick a good one for you then.
They're all good. Let's not discriminate.
Kathy says, can you help with how Roth conversion is taxed if someone lives in two states with different state tax rates, for example, Florida and another state?
If you live in two states, you have to figure out which one is your principal residence in that year, right? Which is usually defined as 6 months and a day, right? And the other one by definition is less. And so that state that you live in the majority of the time is what the state you're going to be taxed in as far as a conversion. That's if you're living in both states all throughout the year. On the other hand, some people live in one state half the year and move to another state. So they're living in two separate states. And there's a couple ways to look at it. One is to kind of spread it out over the year, half in one state, half in the other, if you moved at mid-year. Another way, which is completely justifiable, is you paid the conversion tax in the state you're living at the point of the conversion, which is probably what I would do.
Okay, that's it. Hopefully you guys enjoy this stuff. We have a lot of fun doing it. And what you can do, when you click on that link that Andy has, right, we got this tax reduction analysis. You just click on a date there, no big deal. And then we'll get you all set up. So there's a lot of things that you can potentially do by the end of the year. Let's get it done before it's too late. It usually helps to get in earlier than later, but it never fails. It seems like you guys then call us on December 20th and saying, hey, I have an emergency. Can you help me? So we're in August, so we got September, October, November. So we have a few more months left. It should be an interesting ride all the way through this awful year. But hopefully you're all staying safe and and being happy as much as we can. And that's all I got. Big Al, you got any parting words?
No, I think right now there's some real opportunity tax-wise, and I think those that pay attention are the ones that usually end up in a better spot.
All right. Well, that's all we have for you today. Andy, anything else from you?
I think we got everything. Thank you guys both so much, and keep listening to the YMYW podcast and watching Your Money, Your Wealth television show.
Yeah, well, thanks a lot, guys. The show and the podcast and everything else wouldn't be anything without you guys kind of at least watching it. For I think the first 6-7 years, we had 2 viewers and listeners. It was my mom and Big Al's mom. And so now we've expanded. At least there's a couple hundred people on today. So it just took us 15 years, Al.
Yeah, well, better late than never, right?
You got it. All right. Have a wonderful rest of your week, and we'll see you again real soon. Thanks, guys.